Welcome back. You're watching HFO-TV. HFO-TV is co-sponsored by J.R. Johnson LLC, specialists in multifamily restoration and repair work. Gantry Incorporated, the nation's largest independent mortgage banking firm. Butler Exchange Group, offering 1031 tax-free exchange services. And Forensic Building Consultants, experts in the diagnosis, repair, and preservation of multifamily assets.
Hi, welcome back to HFO TV. I'm Greg Frick, partner at HFO Investment Real Estate, and today we have Victor back again, kind of give us some insight on a national and a little bit local, kind of the economy and what he's seeing. So Victor, thanks for taking the time. It's always better to see you in person, but we've got to do what we can do.
Greg, let's figure something out next year because I have been traveling again and pumping up those traveler statistics. I have been,
we have too a little bit. Yes.
Every single week since Labor Day, all the way to December, believe it or not.
And are you seeing we'll digress a little bit, ongoing in these things and events, are the numbers up? Is it people trying to get together because they haven't had a chance? Or what are you seeing when you go to these conferences?
I do think that the conferences are packed, and we have a lot of clients basically saying, hey, would you come in and give us in-person market briefings? It's refreshing for me to get together with people. I do think that our transition from the pandemic days has shown that people do want to gather. People do want to go to restaurants. People do want to watch live performances. But there is an open question as to whether they want to gather in offices during the standard workday pre-COVID. Right. So I do think that's an open question.
And do you see a difference where you go in different parts of the country where it's more people more ready to get together, or it doesn't really matter where you are in the country?
I do think that if you take a look at weekday statistics, we're seeing a whole lot more of people gathering in standard office space during the week for markets like Texas, for markets in Arizona, as opposed to the coastal cities like San Francisco and New York. I do think that at this point, we can correlate that with relative perceptions of crime, with relative perceptions of the safety of public transport. So to the extent that you can take your car to work and find pretty easy parking, then you're more likely to show up in the office if that's really appropriate for your function. I also have found that in general, you've got a lot of the younger people or folks who have started a bit earlier on in their careers for respective firms wanting to gather. They believe that the proximity matters if they need to learn things that aren't exactly codified, things that are tacit, things that you'll need to be close to one of your mentors and your bosses to learn. And so it's a really interesting dynamic as to how the workplace is evolving.
Yeah, and I'm always wondering, how do you get the mentors and the partners back in the office, as because like you said, you've got the younger generation wanting mentorship, wanting that connection, and how do you get the intellectual talent that's been there for 20 years saying, well, geez, I like this 2 days a week out of the office. What kind of synergy is that going to lack, or how do you kind of get that momentum going again?
Yeah, Greg, I do think that some of the more enlightened employers have reminded their more senior folks that their job is not just as individual producers, but as teachers and mentors, right? And if you're a teacher and mentor, you probably do need to spend time in proximity with your people. Now, if you're managing a global organization with teams all around the country or in different time zones across the Atlantic or in Asia, then the reality is you have probably lived with a hybrid platform for some time. But I do think that people do want to gather, and not everything about every job can be emailed, codified, set down in a document, right? If there's just some part of it that feels like an apprenticeship, then you're going to want that proximity.
Now, kind of talking about, if everybody wants to talk about interest rates and the effect on what we've seen, and in the multifamily world, we saw in our market, record transaction volume from dollars and number of transactions in 21. I didn't expect 22 to match that, though the first 3 quarters were kind of on pace. We were going to fall a little bit behind. The question is, what are you seeing nationally in terms of the effect on, what interest rates are doing, kind of what's your take on, where we're going to be here in the next, 90 to 60 days, or 90 to 6 months, excuse me.
Yeah, I do think that in general, the uncertainty around where rates would be or where the benchmark 10-year treasury rates really caused a lot of the big blowout in bid-ask spreads, right? And what
Right.
that basically means is we're figuring out what prices ought to be. If we're benchmarking off of 2021, or I'd even time it at around February or March 2022 highs as a seller, then you're probably not seeing eye to eye with a whole lot of buyers or expecting a 10, 20, 30% haircut at this point, given how the cost of funds have risen. And I'm just going to raise my hand and say, man, there was a head fake, right? At around late June, we were at 3.3, 3.4%
Right.
10-year treasuries, right? And then it began trending downwards. We even hit like 2.8. And so there was that false hope, I think, and the markets reflected it, that you know what, we'd stabilize. And yet now we have the 10-year treasury, our benchmark risk-free rate at 4.1, 4.2. Gosh, what kind of world should we expect at a world, given how rates might stay elevated at this point? So, bottom line, I think we're looking at still a whole lot of uncertainty. We're going to figure out whether third or fourth quarter data will reflect that kind of slowdown in transactions that we didn't quite see first
Right.
half of this year. Because as we expected, right, as interest rates began to rise, there were probably a whole lot of deals that needed to happen.
Well, there was a rush with deals that were locked in, trying to push to get through, and then yes,
Exactly.
yes,
It's that
yes.
last rush, right? And
Right.
then now we're seeing whether or not that ice will really, that quote unquote ice age for transactions will really begin to take root. And I think we're still seeing that quote unquote car crash in somewhat slow motion unfold.
And then what, in our world with employment, I mean, are you expecting to see, we're not going to see the decrease in rates or not the step up of rates until we see unemployment to kind of tame this inflation? Or what's kind of your take on, I was out somewhere last night and looked behind me and I was like, God, it doesn't feel like everybody behind me in this restaurant has, there's no effect in terms of they must not be in the refinance business. They must not be in the lending business because everything seems, happy-go-lucky. I'm just wondering, do you think we're going to see, unemployment get up, or what's kind of your take when you're looking forward?
I do think that that's your canary in the coal mine, right, Greg? To the extent that the labor markets are still healthy, quote unquote, at least based on the last BLS release from one or two Fridays ago, right? We're still creating 261,000 net jobs last October. Now, you got to superimpose or juxtapose what's going on with Meta or Facebook saying they're going to lay off 11,000 people, with Amazon a few days, past early November saying that they're going to lay off 10,000 people, right? How does that shake out? And I do believe that once that monthly jobs number from the BLS turns negative even once, well, statistically, that's when the dominoes start falling. There's a 50% chance we will have entered a recession by then. And if there's a second consecutive month of negative job growth, then that's an 85% chance we've entered some kind of downturn. And so that's kind of my canary in the coal mine, Greg, where the other shoe has yet to drop. The other shoe of sentiment has dropped. Clearly, sentiment has turned negative because of geopolitical uncertainty, higher energy prices, persistent inflation. But on the plus side, for glass half full, a lot of more real-time present measures of inflation, things like the producer price index and others. It's showing that we're kind of getting it under control, right? And so it's a mixed bag. It really is a mixed bag. And all I'm 100% sure of, Greg, right now is that I don't think you and I want the job of the Fed, right?
No.
You're just guaranteed to make a mistake, right? You're gonna raise rates too fast, too slow, too much, too little.
It's not gonna. You can't make everybody happy. They're just gonna be. Now on the West Coast, so we're hearing about all the layoffs. The potential layoffs, Amazon, Facebook. I mean, is that the same thing? You're in New York, New Jersey. Is it the same, or is this more like? Part of me feels like is this the high tech that kind of has been. They probably were kind of like we've talked about with pricing changing now in the last six months. Is it kind of, hey, it was getting a little heavy on top? Maybe this is their way to, kind of trim it down a little bit. Are you feeling that in New York, Boston, and the East Coast where there's talks of pending layoffs, or is this more of a high-tech thing? Like I said, we're a little jaded out here.
No, I get it. And as usual, until we have the full national picture, it's going to feel very regional. We're all going to wonder, is this a one-off or is it more systematic, right? It's Is it just Facebook? Is it just tech that's laying folks off? Because you know what? They were pretty exuberant throughout 2021, and now the chickens have kind of come home to roost. Is it the
Well, we can say they've been pretty exuberant for longer than just 2021. I mean,
yeah. And so they've built up, and they've created great engines for business that are nothing like what we saw from 1999 to the year 2000, right? So this is not the tech bust of the year 2000, 2001. With that said, have they grown a little bit too much given how aggregate demand seems to be pulling back? If the answer is yes, then they're going to have to make job cuts, just like the rest of us boring industries.
Right. And then another question is the effect on, single family home ownership. Are you predicting because of rates we're going to see single family home ownership percentages go down, which again, bend for more demand? Again, this is saying that, we're not having rampant unemployment, but that we'll have more demand on the multifamily side. Because as you know, you're looking at an interest rate, I think when I checked this morning, it was 6.5%, 7% for single family. You're just not going to have enough people that have the ability to go, take that on. Are you seeing that nationally?
Not just yet, but you know what? Here's the thing. Ultimately, we are kind of short on the housing supply front. That will tend to keep prices up. We are projecting around a 10% price decline for homes as a whole, just because homes have become so much more expensive. But just think about the benefits on the other side for multifamily, where a whole lot of would-be homeowners are probably thinking, wow, it's way too expensive with a 7% mortgage, and maybe I'll postpone my home buying decision for another year or two, keeping them in multifamily apartments and really propping up rental units occupancy as well as rent growth. And so we're seeing that happen right now, where the multifamily sector on the income side, right? So rents and vacancies still incredibly strong. I'm sure you've been tracking a whole lot of apartment REIT announcements. All of them are basically saying we're fine. We don't have like rent collection issues. Our occupancy rates are our occupancy rates are above 95% or more. So we're not seeing it on the income side. Greg, I do think the action is happening on the capital market side because of higher rates, higher cost of funds, and a lot of investors basically saying, you know what, that 3.5, 4.5 cap rate, we might have swallowed it 2 years ago.
We're not going to do it now. But the I tell people the fundamentals on the operation side, between, like we said, the rental growth, home ownership percentage going down, the spread between replacement cost and existing, because now the cost of construction, they're all benefiting kind of a long-term play. It's just like you said, it's on the capital investment side. Is we said we're looking at the party yesterday. I'm looking back, like I said, these people aren't on finance. They're not in refinancing. They're not on the capital side. Everything's rosy. So you kind of have that feeling in our market right now.
Yeah, and then you tell me, Greg, you're like, okay, well, construction financing has undoubtedly dried up, because who wants to take a bet on a longer term building right now, right? But guess what that does? Does that not pull back on supply growth? Which means in which case does that not mean you have less of a glut to deal with, and does that not prop up occupancies and rent growth? And so it's such an interesting time right now, where unless and until we really encounter a recession, and if it's deep, and if it lasts a long time, we might see this interesting interplay where some sectors like multifamily might experience a slowdown in rent growth. Let me tell you, that party from middle of last year is probably done. But I'm not crying a river for you if you're able to raise rents by 10%.
No, we need to, we can't go too crazy in multifamily, because then we get the political pressures of rent control and rent caps and things like that. I mean, I always tell people,
Well, Greg, like a quick history lesson. Before the pandemic took over the headlines, was the headline not that 4 states had enacted some form of rent regulation? Right.
Yep.
29. This was what we were talking about in late 2019. That's rearing its ugly head again, right?
I know. Yes. And heck, we didn't even talk about climate change either. So
yeah, I couldn't believe Florida markets like Orlando are talking about rent regulation, right? So it's out there. It's true that affordability is an issue in the United States. It's always been an issue. That's why we've had rent control measures since, World War II, right? But the solution, of course, long run, is to increase supply and not to cap rents. That's easier said than done.
No, but I am getting a sense politically there seems to be a kind of a recognition that the zoning has to change. There has to be a push for supply. The issues with the supply chain, just in terms of the cost. I mean, I think California is seeing it now. What's the cost to bring a low-income unit, affordable unit into the market? There has to be ways to lower that, or we're never going to catch up. I mean, especially in these high, demands of where people are moving to.
Yeah, and market dynamics find a way. That's why the Californias of this world, all the talk is about granny flats or ADUs, right? So it's the market dynamics find a way. And to your point, I do think that it was a hopeful note that in the midterm elections, a whole lot of ballots that supported affordable housing got bipartisan support, right? It looks like it's a polarized world, but at least both parties appear to agree that affordable housing is a priority. And that's a hopeful note.
That's at least a start. I don't know if they're going to agree how to get there, but at least we have a start. There's a agreement on that. We have to provide more.
Yep. I totally agree. And you know what? I'll take it. There's a lot of bad news out there, so I'm going to take some of the good news.
Most definitely. Well, thanks. I know we're out of time. Thanks for taking the time today. I'm sure we will get together in person here. I'm coming out to you, or we'll have you come out again. I mean, I always joke around with you. Last time we had you fly out, you had a little, mishap getting into the airport. So hopefully that doesn't happen again. So
I hope it doesn't happen again. The one thing I would like to share, Greg, is that the body weight inflation that came upon me during the pandemic proved pretty persistent, but apparently it's transitory. So I've lost all of that, right? It's great. So I'm hoping that to keep it real, when I see you, I will still maintain it, as opposed to,
I'm glad you worked in the word transitory, because I was just talking, that was kind of the Fed's little, that's 22, it was all inflation's transitory, it's going to go away. That's, yes.
Oh, no. I got to say, up till around August of 2022, I thought my body weight inflation transitory. I thought I'd have to live with it forever, but you know what? I did not order fat pants. I did not throw in the towel. I just lost the weight. So
well, see, maybe you should go to the Fed then. Maybe you should go to the Fed. You recognize it and made the changes.
Thank you for having me, Greg.
Thank you again. We'll talk to you soon. Thanks, Victor. All right, thanks. And we'll see you again next time on HFO-TV. Thank you.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.